Every single day, millions of people around the world wake up and go to work, trading their time for money. But there is a small group of people who have figured out something different. They make their money work for them while they sleep. The stock market is one of the most powerful tools ever created for building long-term wealth. And the good news is that it is not reserved for Wall Street insiders or financial geniuses. It is available to anyone willing to learn how it works. Think of the stock market as a giant marketplace where people buy and sell small pieces of companies. When a company wants to raise money to grow its business, it can offer shares of ownership to the public. When you buy one of those shares, you become a part owner of that company, no matter how small your investment is. If the company grows and becomes more valuable, your shares grow in value too. That is the fundamental idea behind investing in stocks, and it is simpler than most people realize. The fear that keeps most beginners away from the stock market is not really about complexity. It is about the unknown. People are afraid of losing money, afraid of making the wrong decision, and afraid of a system that feels designed for someone else. But here is the truth. Staying out of the market entirely is itself a financial decision, and often not a great one. Inflation quietly erodes the purchasing power of money sitting in a savings account, while invested money has the potential to grow significantly over time. Before placing a single dollar into the market, it helps to understand the basic mechanics of how it operates. Stock exchanges like the New York Stock Exchange and the Nasdaq are the platforms where stocks are bought and sold. These exchanges operate during specific hours, typically from 9:30 in the morning to 4 in the afternoon, Eastern Time on weekdays, excluding public holidays. When you buy a stock, you are not buying it directly from the company in most cases. You are buying it from another investor who is willing to sell. The price of a stock is determined by supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. This constant movement of prices is what makes the market feel unpredictable. But over long periods of time, the overall market has historically trended upward. There are different types of stocks worth knowing about. Common stocks give you voting rights in company decisions and the potential to receive dividends, which are small cash payments companies sometimes distribute to shareholders. Preferred stocks, on the other hand, typically do not come with voting rights but offer more stable dividend payments. For most beginners, common stocks are where the journey begins. Beyond individual stocks, there are also index funds and exchange-traded funds, often called ETFs. These are collections of many stocks bundled together, which means buying one share of an index fund gives you exposure to dozens or even hundreds of companies at once. This built-in diversification makes them an incredibly popular choice for new investors. Getting started in the stock market in 2026 is easier than it has ever been. The first practical step is opening a brokerage account. A brokerage is essentially the middleman between you and the stock market. There are many reputable online brokers available today, and most of them offer commission-free trading, meaning you do not pay a fee every time you buy or sell a stock. When choosing a broker, look for one that is regulated, has a clean user interface, offers educational resources, and has no minimum account balance requirements. Once your account is open and funded, the next question most beginners ask is, what should I actually buy? This is where having a strategy matters more than picking the hottest stock of the moment. A common and well-respected strategy for beginners is called dollar-cost averaging. Instead of trying to time the market by investing a large sum all at once, you invest a fixed amount of money at regular intervals, say $100 every month, regardless of whether the market is up or down. Over time, this approach smooths out the impact of market volatility and removes the emotional pressure of trying to predict price movements. Another foundational principle is diversification. The old saying about not putting all your eggs in one basket applies perfectly here. Spreading your investments across different sectors, technology, healthcare, energy, consumer goods, reduces the risk that one bad investment will devastate your entire portfolio. One of the biggest challenges for new investors is learning how to interpret market information without becoming overwhelmed or emotional. Financial news channels and social media platforms are filled with predictions, opinions, and dramatic headlines designed to grab attention. Learning to filter signal from noise is a critical skill. A few key metrics are worth understanding early on. The price-to-earnings ratio, commonly referred to as the P/E ratio, compares a company's stock price to its earnings per share. A high P/E ratio might suggest a stock is overvalued, while a low one could indicate it is undervalued, though context always matters. Market capitalization, or market cap, tells you the total value of a company's outstanding shares. Large-cap companies are generally more stable, while small-cap companies carry higher risk but also higher potential for growth. Earnings reports are another important signal. Every quarter, publicly traded companies release financial results showing how much revenue and profit they generated. These reports can cause significant short-term price movements, but long-term investors often look past the noise and focus on the overall trajectory of a business. Understanding these basics helps you make more informed decisions rather than reacting to every market swing with panic or excitement. The single most important factor in stock market success for beginners is not intelligence, not timing, and not having access to insider tips. It is patience. The investors who build real wealth over time are the ones who stay consistent, avoid emotional decision-making, and allow compound interest to do its work. Compound interest is often described as the eighth wonder of the world, and for good reason. When your investments generate returns, those returns get reinvested and begin generating their own returns. Over decades, this snowball effect can turn modest monthly contributions into life-changing sums of money. Starting early matters enormously. Someone who begins investing at 25 years old with consistent monthly contributions will likely end up with significantly more wealth than someone who starts at 35, even if the later starter contributes more money overall. Time in the market consistently outperforms timing the market. There will be crashes, corrections, and moments of genuine uncertainty. Every generation of investors has faced them, and every time, the market has eventually recovered and reached new highs. The investors who panic and sell during downturns lock in their losses, while those who stay the course benefit from the recovery. Building a long-term mindset means accepting short-term discomfort in exchange for long-term reward. Start small if you need to, stay consistent, keep learning, and trust the process. The stock market rewards those who show up, stay disciplined, and think in decades rather than days.